Good morning. Cap rate spread, the hidden metric that pros watch. So, most commercial real estate investors obsess over cap rates and interest rates independently. However, professionals tend to focus on the cap rate spread, and that's the difference between a property's capitalization rate and the prevailing borrowing costs. And this spread determines quietly the deal safety, your pricing pressure, your refinancing risk, and long term returns. So, if you want to understand why some investors confidently buy in volatile markets while others freeze, that metric is usually the reason. So, let's take a look at what is a cap rate spread. Well, cap rate spread is the difference between a property's cap rate and the investor's cost of capital, usually whatever they can take out long term debt for. So, the formula is the cap rate spread equals the cap rate minus the interest rate. Say, for example, you're dealing with a property that's got a cap rate of 6.75%. And your loan interest rate is 5.75%. So you have a cap rate spread of about 1%. And that spread is going to act as a risk buffer against market volatility, rent fluctuations, and refinancing uncertainty. And why cap rate spread matters more than cap rate alone. A low cap rate is not inherently bad, and a high cap rate is not inherently good. What matters is how pricing compares to capital costs. So when spreads are wide, buyers have more margin for error. And when they're tighter, deals become sensitive to rate changes. And if you have negative spread, investors relying on appreciation of the building or rent growth to survive. So sophisticated investors know that compressed spreads amplify the risk, especially in leveraged deals. Let's give you some historical context. What spreads tell us about market cycles? And historically, wide spreads signal buyer opportunity and disciplined pricing, whereas tight spreads indicate frothy markets and aggressive assumptions. And negative spreads often precede pricing corrections or distress. And in recent cycles, rapid rate increases compress spreads faster than property prices. So it could adjust, creating a taste standoff between buyers and sellers on what the value of a property is. Now let's look at cap rate spread and lender underwriting. Lenders care deeply about cap rate spread, even if they don't label it that way. And what it does is it directly influences your debt service coverage ratio, or DSCR. It can affect refinancing risk at loan maturity. It affects exit cap assumptions. So it helps to stress test scenarios. And deals with thin spreads often fail late in underwriting, not because the property is bad, but because the capital stack is a little misaligned. So let's look at how professional investors use cap rate spreads strategically. And here's some insights from experienced buyers I've worked with. Underwrite forward spreads and not just today's numbers. Stress test refinance scenarios at higher rates. And you need to price risk into your exit cap rate assumptions. And you need to adjust leverage to protect spread integrity. And this is why pros can move when headlines are bearish. They're buying structure and not headlines. So here's the key takeaway for the day. Cap rate spread is the quiet signal that reveals whether a deal is durable or fragile. And if you're only comparing cap rates or waiting for great cuts, you're missing the most important metrics professionals watch. And understanding spread discipline is how investors survive cycles and compound wealth over time. And that, my friends, is it for the day. Please visit my website, HoustonRealEstateBrokerage.com, to get a hold of me, and I'd love to chat more. Take care.